Okay, good afternoon, everyone. Welcome back to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're going to be talking about the top 3 income strategies that you can trade utilizing weekly options. Today we're going to talk about basically, regardless of what your views are on the underlying market, how you can utilize different option strategies to generate income so that regardless of whether you're bullish or bearish on the markets, or if you own some stocks, or if you want to own some stocks, regardless of what any of these scenarios are, you always have some opportunity to potentially generate some income by selling options, specifically in the weekly options. And we'll talk a little bit about why weekly options are best for these types of strategies. So today we're going to go through 3 different strategies. I'm not going to go really in depth into each one. I want to spend more time, more as an overview for those of you that want to take a look at what are the different options for generating income. We do have specific webinars that go a bit more in depth into each one of these specific topics. So you can always go back to watching some of those pre-recorded webinars that we've had on these topics if you want to learn more about credit spreads or cover calls and cash secured puts, which are some of the strategies we'll talk about here today. Before we get actually started into talking about options trading, I just want to remind everyone, when you trade at Firstrade, you have $0 commissions on stocks, ETFs, options, and mutual funds. This is huge for those of you that sell options for income, because when you're selling options for income, generally speaking, you're collecting limited amounts of premium. Many times you might be collecting only 20, 30, 40 cents a contract. And if you're paying $10, $15 in commissions, you're eating up a very, very large percentage of your trade in commissions. So by trading at Firstrade, you are completely negating that fact that no one else really has this opportunity to trade completely commission-free, specifically regarding options. And that's really where you see the largest impact to your bottom line. So really, really relevant to the topic that we're going to talk about here today, how zero commissions will impact your bottom line. And just a real quick reminder, Firstrade, Kiplinger's best online broker 2018, #1 for ETF and bond investors. So for those of you that trade those types of assets, especially ETFs, I know a lot of you guys trade that. Keep in mind that it's one of the best brokerage firms to trade this at. So let's talk about what we'll go over here today. #1, we're going to talk about the top 3 income strategies. The reason we're covering 3 different income strategies is because depending on what your views are on the market, depending on which stocks you hold and different scenarios that you might find yourself across, you're going to need different types of strategies. So we want to go over the 3 most popular strategies and when you should utilize each one. Then we'll talk about expiration and strike selection. So with each one of these strategies, what expiration should you choose? What strike prices should you choose? And then generating a consistent income. How can you use these 3 strategies to generate consistent income? What are the best practices there? We're going to go over some of those. And most importantly, I think we want to cover some exit strategies. So for those of you that are trading these types of strategies, once you're in them, once you've sold the cover call or a cash secured put, how do you manage that position? So we'll talk a little bit about the exit strategies. And then lastly, what I really want to spend the most amount of time on is showing you these strategies using Options Play. This is a free tool that's available to all Firstrade customers. Highly recommend you to take a look to help you better understand your option strategies, help you analyze them so you know exactly what your potential risk and potential rewards are. Very important to do that before you place a trade and not after. So those are the things that we're going to go over here today. We're going to start off by talking about what those 3 income strategies are. They're cover calls, which for any of you that have registered for an options trading account, you're familiar with what a cover call is because that's the first thing you're approved for. Short puts, which is a little bit more advanced strategy, and a lot of people feel that short puts have a lot of risk, but I really want to explain how short puts actually has less risk once you think about what you're comparing it to. And lastly, credit spreads. This is really what allows you to generate income when you don't own a particular stock and you have a mild directional view. It's an extremely forgiving strategy that allows you to potentially profit in a lot of different environments. Those are the 3 strategies that we want to talk about here. Now, before I start launching into each one of these strategies and how to trade them, just a quick poll here. How many people have traded cover calls, cash secured puts, and credit spreads in your account? If you have, please type yes into your chat window. If you've never traded any of these strategies, or if you're just learning, please type no into the chat window, just so I get a feel for the audience here in the room. Okay, it seems like a majority of yeses, but actually quite a few no's as well. So for those of you that have traded these strategies, really what we're hoping to go through here today is making sure you understand what are the best practices and how to utilize these strategies efficiently. And for those of you that are brand new, I hope this inspires you to really take a look at each one of these strategies, maybe go into the webinars that we've done specifically on some of these strategies so that you can learn more about them, and really more importantly, show you the tools so that you feel confident in being able to analyze these strategies on your own and start trading them on your own. So we're going to start by cover calls, because this is really where everyone that has an options account is approved for cover calls. This is a strategy that adds yield to the existing stocks in your portfolio. And that's the key word here, is that existing stocks in your portfolio, because you can only sell cover calls on stocks that you have at least 100 shares of in your stock portfolio. If you don't have 100 shares of stock, this is not a strategy for you. You should move on to the next one. But think about all the stocks that you have in your account. Are you utilizing them currently to generate yield? If you're not selling cover calls on the stocks in your account, you may be missing out on some additional yield. Some of those stocks may pay dividends, but there may be plenty of stocks in that account that don't pay any dividends or pay very minimal dividends. How can you add yield to those stocks? By selling cover calls. So this is one of the most popular strategies. About 40% of all flow on the retail side is in cover calls alone. So if you're not utilizing them, this is a strategy that you should start considering. So for all of you that answered no to the previous question, this is where you should start with respect to learning about income strategies, is selling cover calls against the stock that you own in your account to generate some additional yield. We're going to show you some examples of that so you know how to go about doing this. And the goal of selling cover calls is really to lower the portfolio volatility of your account and the cost basis of the stock that you own. So you're going to be able to generate some yield, some income for your portfolio, and you're going to lower the portfolio volatility because that income is going to help offset that volatility, and you're reducing the cost basis of the stock that you own. So this is really the three-pronged approach to selling cover calls. Next, what I want to talk about is short puts. And this is really where a lot of people will tell me, well, shorting puts has a lot of risk. Why would I do that? And the answer is you always have to compare shorting puts to buying stock. And a lot of people, that doesn't make a lot of sense. But when you're shorting a put, your risk is that you end up owning the stock at the strike price that you've sold. This is a slightly more advanced strategy. But whenever you're considering buying a stock, you should consider selling a put instead. And this is something that a lot of people feel that they're not ready for this type of risk. But in reality, you have actually less risk from shorting a stock than buying the stock at the current price. Because what the short puts allow you to do is buy the current stock at a lower price while introducing some income for placing that order. So if you sell a put for a couple of dollars on a $100 stock, that allows you to buy that stock at $98 as opposed to buying that stock outright at $100 currently. Because if you buy a stock at $100 today, you risk $100 if the stock goes down to zero. But if you short a put, you still have the opportunity of buying that stock at $100, but because you've collected a $2 premium on that short put, now your risk is only $98 instead of a full $100. So when you compare a short put to buying a stock, you actually have less risk. You certainly have more risk with short puts than a lot of other strategies, but you have to make sure that you compare it to the right strategy, which is buying a stock. And that is really one of the more underutilized strategies, in my opinion, in most people's portfolios, is that a lot of you buy stocks, but you haven't considered shorting a put as an alternative to buying that stock. And I hope that this webinar today kind of inspires you to consider taking a look at that. And like I said, with both the cover calls and short puts, I'm going to show you some real examples with some real stocks that's really going to help solidify these two concepts. And lastly, the third strategy, if you don't own any stocks and you're not looking to pick up any stocks, which is what you would do with cover calls and short puts, you can take a look at credit spreads. This is really where it allows you to generate income with limited risk. This is a fairly forgiving strategy that allows you to take a mild directional view on any stock or ETF and generate income on that directional view. And we're going to give you some examples of this in a few minutes. And credit spreads as a whole is, in my opinion, a whole separate webinar on its own. And we have done a webinar previously on credit spreads. So if you want to learn more about the structure of this trade, the best practices, and kind of some more examples, please watch some of our previously recorded webinars on this topic. We do get a lot more in-depth on the credit spreads. So with all of these strategies that I just talked about, cover calls, cash secured puts, and credit spreads, we generally find that it's better to trade the weekly options versus the monthly options. And when I refer to weekly options, that doesn't just mean specifically strictly the weekly options. The monthly options can still fall under that category if it's less than 7 weeks from expiration. So when I'm referring to weekly options, I'm just referring to anything that's less than 7 weeks from expiration. What I have here is a chart of time value of premium. So meaning if you hold all things constant, the value of an option will actually erode as time goes on, and that erosion gets faster and faster as you get closer to expiration. When you're selling options for income, when you're selling covered calls, when you're selling a short put, when you're selling a credit spread, this time decay function that you see on this curve is working in your favor. And as you can see, it actually works faster in your favor in the last month than it does in the previous 3 months. So you actually collect roughly the same amount of premium in a 1 month time span as you do in the previous 3 months prior to that. That's why we generally want to sell short-dated options, because we're able to capture this time decay much faster. So for example, if let's say we're collecting $1 from month 4 to month 1, we can collect another $1 from month 1 to month 0. So would you rather collect $1 in the time span of 1 month, or would you rather collect $1 in the time span of 3 months? I think everyone would agree that you want to collect that $1 in that last month. So that's really why weekly options is optimal for these types of strategies, because you're able to capture that time premium much quicker and reach a potentially profitable trade much, much faster when you're trading weekly options. So I just want to talk a little bit about now the thought process to when you should deploy these strategies. So cover calls is really for the stocks that you own in your account, and you generally have a bearish or neutral view on that stock in your account, but you don't want to sell it. So let's say you have 100 shares of Apple. You feel that the Apple stock has kind of reached a peak. It's not going much higher. You certainly don't think it's going to rocket significantly higher. You think it could stay where it is or move a little lower. That is when it is the ideal time to sell a cover call. And you always want to sell a call strike prices above the current price when you're selling a cover call. So if you have a $100 stock and you're trying to sell a cover call on it, you always want to sell a strike that's above the current price. So 102, 103, 105, anything above the current price, those are the strike prices that you want to sell your cover call on. When it comes to short puts, this is when you have a bullish or neutral view on the market. So for example, if you are thinking about buying Apple stock, and let's say that stock's trading at $200, and you think it's going to go a little higher or stay neutral, that's when you want to sell a put. And you always want to sell put strikes below the current price. So if Apple's at $200 and you're thinking about selling a put, you might want to sell a 195 or maybe even a 190 put against that. That's where we're going to show you some real examples of both cover calls and cash secured puts of real stocks, so that we can help put this concept of selling higher calls and lower puts in more tangible terms. Lastly, when it comes to selling credit spreads, like I said, I don't have enough time to get in-depth into this specific strategy. It is a more advanced strategy, but what it really is actually just selling either a naked put or a naked call, and then what you're doing is you're buying back another call or a put to limit that risk. And this is a strategy that really is very, very flexible, because you can sell credit spreads when you're bullish, when you're bearish, and when you're neutral. No other trading strategy in the world allows you to do that. If you go buy a stock, you must be bullish. If you short a stock, you must be bearish. If you're neutral on a stock, there's nothing you can do with the stock. With credit spreads, that's not true. If you're bullish, if you're bearish, or even if you think the stock's going to stay neutral, you can sell credit spreads to still take advantage of that. And most credit spreads, as a general rule of thumb, is you want to sell the at-the-money strikes and you want to buy an out-of-the-money strike against that to help you cap your risk. So that's the general rule of thumbs for each one of these three strategies and when you would generally deploy each one of these. So now that we've talked about each one of these strategies, what are some of the best practices amongst each one? How do you actually generate consistent income from any of these strategies? And that's really where it comes down to some of the things that we're going to go over the next few slides. But it's actually not very difficult. So number one, what you have to do is you have to make sure that you're selecting a suitable expiration date, which we talked about that weekly options tend to be better for these types of income generating strategies than longer dated options. And you want to figure out a strike price based on your personalized preferences. A lot of times how you choose your strike prices on these income generating strategies really comes down to your risk tolerance. We'll go through that in a few slides as to what that means, but it's really important that you understand what is the suitable expiration date and suitable strike price based on your own personal preferences. And then the only thing you have to do to generate consistent income is to make sure that you use the same methodical approach every single time. So if you're going to sell a 30-day, 5% out of the money cover call, make sure you stick to that same methodology every single cycle. If you use 30-day options this month and then 60-day options the month after and 15-day options the month after that, you're going to get inconsistent results. And really one of the best ways to get consistency is really using automation. And that's what we're going to show you here today is like how you can use options play to gain the consistency through the automation that we're going to help you provide for both cover calls, cash secured puts, and even credit spreads. So when we talked about selecting an expiration date and strike price that fits your personal preferences, this is what I'm talking about. So I have 3 different buckets up here. Before we kind of dissect each one, I want to talk about your frequency of trading helps you determine what expiration cycle you should choose. So for those of you that are active traders, such as myself, I have the time to look at my account at least once a day. So I would fall under the category of an active trader. This is where I would usually sell options that are anywhere from 3 to 7 weeks out. This is the weekly options that we're talking about, anywhere from 3 to 7 weeks out. The only reason that we don't really go much shorter than 3 weeks is if you go shorter than 3 weeks, you generally may not find enough premium at all. So that's why we usually start about 3 weeks out and then we go all the way out to about 7 weeks, which is where weekly options end. And on the other end of the spectrum, for those of you that don't look at your accounts every single day, maybe you only look at your account once a month or once a quarter. You know, for those of you that buy and hold, meaning long-term investors, you would fall under the category of a long-term investor. You would sell options anywhere from 3 months to 6 months out. And this is simply just a function of how often you look at your account. There's nothing else that you can do, meaning if you only look at your account once every quarter, you should not be selling weekly options. And lastly, many of you may fall somewhere kind of in between these two ends of the extreme. Maybe you don't look at your account every single day. Maybe you look at your account once a week. This is where I call casual investors. You want to sell options that are anywhere from about 7 weeks out to about 3 months out. So those are the types of expirations that you should select based on your personal preferences. Even though we talked about that the weekly options are the ideal for these types of strategies, you don't want to deviate from what's ideal for your own personal preferences. It's just that you may not make as much income in the longer dated options, but it doesn't mean that you're going to be unprofitable. So now that we've looked at the different expirations, what do they actually mean? So when we're selling short dated options, what it really means is that we have a fair amount of certainty as to what's going to happen between now and expiration. When I sell a 3-week option, I have a pretty good idea as to what's going to happen between now and those 3 weeks in terms of corporate actions like earnings, dividends, even product launches and things like that. I have a fair amount of visibility into the next 3 weeks. Conversely, if I sell a 6-month option, I have a lot less certainty. You know, I may know where the next earnings date, but I may not know where the earnings date after that is. I may not know what the next dividend is. I certainly have no visibility into all the product launches and news announcements that may come out over the next 6 months. So I have a lot less certainty. And in exchange for that, what you're going to get is a lot more income. So the question is, which one's actually best for you? So based on all of our research, it shows that you want to be on the shorter end of the spectrum. It's actually better to collect less income more frequently than to collect more income less frequently. So that's just based on our research from backtesting all different types of strategies, what we've generally have found. Next, when we talk about risk tolerance, this is really where it comes down to figuring out what strike prices to sell when you're selling cover calls, cash secured puts, and even credit spreads. So this is really where we look at a few different strikes and we looked at a few different risk tolerances. So for example, if you're a conservative, you want to sell fairly out of the money calls and puts that have relatively low probability of being assigned to you, because when you're selling options for income, you're going to be short that option. You have to take on the risk if the buyer of that option from you decides to exercise their call or put. You have to take that risk. So depending on how much risk you're willing to take, that will determine where you select your strikes. So I have 3 risk tolerances up here: conservative, optimal, and aggressive. And conservative means that you really want to take a low amount of risk that call or put that you've sold has a risk of being assigned to you. So this is really where we use delta to help us determine how far out of the money we want to sell our cover calls. So delta is simply just a proxy for the probability of that call or put being in the money. So if you're selecting a call or put that's a 10 delta call or put, that call or put has a 90% chance that that call or put will simply just expire worthless. So about a 90% chance that you're going to be able to keep the income that you receive. On the other end of the spectrum, if you're aggressive and you're trying to chase a lot of yield and you're trying to maximize your profits, you can choose a call or a put that's much closer to the current price, but that has a higher probability of that call or put being in the money, or higher probability of that call or put being exercised, which means that you do have a lower probability of that call or put expiring worthless. But what you're going to do is you're going to collect more income. And for most of you, such as myself, which fall somewhere in the middle between these two extremes, you want to select deltas that have roughly about a 20 delta, or a 20% chance that that call or put will be exercised, or an 80% chance that you will keep the premium that you receive or the income that you receive. So when you sell really far out of the money strikes, such as in the conservative end of the spectrum, you're going to collect less income. When you're selecting very aggressive strikes closer to the current price, you're going to collect a lot more income. So that's the relationship between aggressive and conservative strikes. So before we kind of move on, make a mental note to yourself. Which time frame do you typically fall under in terms of how frequently you trade? I myself fall under the active trader because I have time to look at my account every day. And then for risk tolerance, I fall somewhere in the middle, optimal, because I'm not looking for too aggressive or too conservative. I do make some changes depending on the stock that I'm looking at, but for the most part, optimal is a good starting point. So I usually always look at roughly about a 20 delta call or a put as a starting point if I'm selling a cover call or a cash secured put. So lastly, just a few more comments on kind of where we find the optimal strikes are. When we look at cover calls, this is based on backtesting about 10 years worth of historical data on the full S&P 500 stocks. We found that by selling different cover calls, we tested all different types of deltas and expiration dates. We found that it's generally speaking best to sell more conservative strikes when it comes to selling cover calls. So 15 to 20 delta is usually the sweet spot that we tend to find when it comes to selling cover calls. And the reason for this is because it gives your stock upside room to appreciate. And the reason for this is because you own the stocks that you have in your account because you think they're going to grow over time. That's why you own them. You want to make sure that you don't cap that growth potential too much by selling very aggressive calls. It might sound good to collect a lot of premium or a lot of income in short-term cover calls. However, that will be offset, or you will lose out on a lot of opportunity for your stocks to grow. And by doing so, you're actually going to underperform your portfolio. So that's why we always recommend to go a little further out of the money, give your stock that upside room to appreciate. At the same time, by selling that 15 to 20 delta call or put, you're still going to be able to bring some income stream into your portfolio. When it comes to selling puts, we generally find that it's better to be a bit more aggressive. 25 to 30 delta is appropriate for selling puts. And part of this reason is because markets generally, on average, move higher. There's a less probability of the stock moving lower than it is for it to move higher, which is why when you're selling puts, you can get a little bit more aggressive. And plus, when you're selling puts, your goal is to some degree to be assigned on that short put so that you can own the stocks that you're bullish on. So that's why we generally get a little bit more aggressive when it comes to selling puts. And lastly, on credit spreads, this is not going to do this enough justice. You're going to have to watch the separate webinar we've done on credit spreads. But the goal of a credit spread is to collect roughly about a third of the width. And the width means the distance between the two strikes, the buy strike and the sell strike. You want to collect roughly about a third of that distance in premium. And that's how you generally find the optimal strikes for a credit spread. So if you're selling a spread that has a $10 wide credit spread. So you're selling the $100 put, and then you're buying the $90 put against that. That's a $10 wide spread. You want to collect roughly $3.33 in order to get the optimal credit spread. Like I said, I don't have enough time to really dive deep into the credit spreads, but we do have a whole webinar just on that one topic alone. So make sure you view that if you're interested in selling credit spreads. So lastly, what I want to talk about is exit strategies. What do you do with any of these strategies once you're in them? How do you manage them? The rule of thumb here is generally with all of these types of strategies, you generally want to hold on to these strategies till expiration so that you keep all the income that you've collected. However, we generally find that sometimes you need to roll that position, meaning you have to buy back the call or put that you've sold, and you need to sell another one. And the goal here is that if you need to do that because the stock has either moved higher or moved lower, you want to wait until the last week before expiration to roll your positions. You don't want to do it too early, because if you do it too early, you can either lock in a loss, or many times you may end up locking in a loss and not have the opportunity to gain that back. So you always want to hold on to a trade. Make sure you take advantage of that time decay before you roll in that last week. Now, we generally do find that these types of strategies do perform well when you're able to take profits early. And the rule of thumb here with taking profits with income trades is that it only makes sense to do them if you have more than 2 weeks left before expiration. Meaning if you've reached your take profit goal, but you're only a week left, you might as well just leave that trade till expiration. But if the trade goes in your favor immediately after you get into the trade and you still have plenty of time left, and you've made 75% gain on the trade or more, and you still have 2 weeks left, that's when it makes sense to take profits early and potentially sell another cover call, cash secured put, or credit spread. And the 2 points that I want to make sure that everyone understands is that I do hear a lot of questions about cover calls. A lot of people are concerned about if their stock gets called away, if that can generate a huge tax bill, and that's always a concern for those of you that are trading cover calls in a taxable account. However, I do want to point out that you don't have to necessarily deliver the stock with the low cost basis. If you have enough cash in your account to buy 100 new shares or buy as many shares as you need to deliver the shares that you sold it at, you can buy stock on Monday when, the following Monday after your cover call has been assigned, you can buy more stock and deliver that cost basis to avoid a large tax bill. So something that not everyone really understands, but I want to make sure that people know that you don't necessarily have to deliver the low cost basis in order to generate that huge capital gains. You can buy more stock if you have the cash to do so and just deliver those. Next, with short puts, these strategies do require you to maintain enough cash to purchase the shares, because short puts is an alternative to buying the shares. You want to make sure that you have enough cash in your account to do so. So those are the 2 tips that I think everyone should know when you're selling cover calls and cash secured puts. Now what I want to do is I want to jump over to options play, and I want to show you some real examples of how to utilize options play to examine cover call, cash secured put opportunities first. Then we'll look at a couple of credit spread opportunities as well. So for those of you that are brand new to options play, welcome. You can find options play under your options trading tab. Once you click on that, you'll see a button here on the right-hand side that says Options Wizard. When you click on that, that will launch options play. And the reason we started this company to provide these types of tools for you is because as traders ourselves, when we were trading options using pages that look like this, we were actually quite confused many of times as to, number one, where to start, let alone once we learned how to use these types of pages, a lot of the analytics that we needed, such as how much yield am I getting on this cover call, or how much return do I get on a credit spread, or how do I compare buying a call to buying a stock? These were all questions that we didn't have the right answers to by looking at the option chain. So a lot of times traders like myself would build these calculators on the side, or maybe we had purchased calculators on the side. And what we do, we input these prices into our calculators, do a lot of manual number crunching, and then come back to these chains and plug in more numbers before we're able to really find the trades that we're doing. And it was very manual and very tedious. What we wanted to do is create a tool that really did a lot of that work for you, or created the calculators inside your platform. and made it a lot easier for you to find the right starting points, because instead of pointing to a option chain and telling you to pick a starting point, we actually present you with starting points that make sense based on your outlook on the underlying stock. So the platform itself is divided into 3 sections. We have trade ideas and watch lists here on the left-hand side. In the middle, we have our security analysis panel. And on the right-hand side, we have trading and income. These 3 panels are what we consider the what, the why, and the how of options trading. Because every day when you come into your platform, you want to know what symbols should I pay attention to. We have fresh trade ideas for bullish and bearish ideas scanned for you every day. You have a watch list that allows you to stay on top of the current market as well as stocks that you want to enter into your own watch list. The middle panel is our security analysis panel, designed to give you snapshot data of what's currently going on with each stock, so that for whatever stock that you type in, we're able to provide you with snapshot analysis of the current trend of that stock, the relative strength of that stock, and important information like earnings, dividends, and price action data right here at the bottom. And then everything here on the right-hand side is driven based on your given outlook. So if you're bullish on Goldman Sachs, we'll present to you 3 bullish strategies, always representing buying the stock, which is something that, for those of you that answered no to that first question, if you've never traded any of these option strategies, you've probably traded stock before. So this is always a strategy that you'll be familiar with. And then what we compare it to is buying the simple call option and then buying a debit spread or a more advanced spread for those of you that are looking for a directional view. And the important thing here is putting the 3 side by side and giving you calculators so that you can simulate if the stock goes higher by a certain date, how much money do I actually make from each one of these 3 strategies, and compare them side by side. Really important calculators that help you determine your risk and reward before you get into a trade. So I'm going to come back to the trading tab here in 1 second as we talk about credit spreads. But for now, what I want to do is I want to jump over to the income tab. This is where I want to start off by cover calls and cash secured puts for those of you that are looking to sell cover calls and cash secured puts. Now, notice that if you wanted to sell these strategies on any symbol, traditionally you'd have to pull up the option chain, you have to pull up Goldman Sachs, you have to pick an expiration date, then you have to pick a strike price. So this is a lot of work for you to figure out just a starting point. You know, as a professional, I know that if I'm looking at Goldman, I'm probably going to look at maybe a November 30th as my starting point, because that's about 3 weeks out from expiration. As an experienced trader, I know that I want to look at out of the money options that yield me a certain amount of premium. But even for me, it's more of an educated guess as to where to start. Conversely, when you go to options play, we tell you exactly what expiration and strike price, because we customize these based on your user preferences. So when you click on the income tab, at the very bottom, there's a button that says income settings. This is what we were referring to here before when we said that you should select an expiration date based on how actively you trade. You should select your strike prices based on your risk tolerance. So this is where you can input those custom settings into options play, and we will actually return cover calls and cash secured put ideas based on your personalized settings. So for me, I like to sell short dated options because I'm fairly active, suitable for active investors. And for cover calls, as I said before, when it comes to risk tolerance, I select optimal because that's where I fall under when it comes to cover calls. And for cash secured puts, I like to get a little bit more aggressive because I want to actually own the stock when I sell these puts. And I'm okay taking a little bit more risk when I'm selling puts on a stock. So these are the 2 settings that you can set independently of each other for calls and puts. And once you save as default, you can create a watch list of the stocks that you want to sell a cover call on. You can click on any of them and immediately see which cover call and cash secured put meets your personalized settings. This is a lot faster than pulling up a chain manually, going through all the expiration dates, going through all the strike prices, trying to figure out where's your ideal starting point, and then doing calculations. Instead of doing that, everything is already done for you. So if you're starting to sell cover calls on Intel, it'll ask you, do you own shares of Intel? You can select yes. You can even select the number of shares that you own. And it tells you how many contracts you can sell. So here, this is telling me to selling the November 30th, 51.5 cover calls, which is about $3 above the current price. They will produce an 8.4% annualized return on a stock that pays only a 2.5% dividend, I'm going to get an additional 8.5%, and there's an 81% chance that this call will expire worthless. So that gives me all the stats that I need to know exactly what my expected return for this strategy is, what is the probability that I'll keep the premium on this particular trade, so that I can instantly make a decision is that if I want to sell a cover call on Intel. And the key here is that I can add an additional 8% yield to my Intel stock that's already paying me a 2.5% dividend, which brings my total yield to 11%. So you're going to increase your yield from 2.5% by owning Intel to almost 11% by selling covered calls on top of that. That's why this is the most popular trading strategy to generate income for amongst all options traders. And as you can see, this makes it as simple as possible because you don't have to pull up an option chain. You just put in your settings, put in a symbol, and we will return to you the optimal cover call. So here, again, for Microsoft, let's say I own 200 shares of Microsoft. This will tell me to sell 2 contracts of the November 30th 117 calls, which is roughly about $5 above the current price. It yields 7.5% on a stock that pays only a 1.7% dividend yield, which brings my total yield to 9.2%. So it gives me all the information that I need that once I'm ready to place that trade, I can hit the trade button, I can hit preview order, and that will open an order for you immediately in Firstrade. And this is one of the best parts of our integration is that you don't have to enter any of these things manually. You can click the trade button, it will pre-fill that ticket for you. Let's just go back to options play real quick. If you click on the income tab again, now what I want to look at is selling a cash secured put. And this is really where, let's say you want to buy Microsoft, but you're not ready to pay $112 for it right now. You think that's a little too expensive. You want to pick it up at a lower price. What would you do normally? You'd put in a limit order, right? You put in a limit order to say, I'll buy this at 109 or 108 or 107, whatever, a lower price than the current price. So what if I told you that you can put in that limit order and get some premium for that? So here is a way to look at, instead of buying Microsoft at 112, what you can do is you can sell a November 30th 109 call. So that's about $3 below the current price, but you're going to collect $148 to do so. So imagine if someone said, I'm going to pay you $148 to place an order to buy Microsoft at 109. Is that something you're interested in? As you can see, the annualized return on that is 21%. Because you're going to collect 1.3% of the underlying shares in the next 23 days. That annualizes out to almost 21%. So this means that you can pick up Microsoft shares at 109. If Microsoft goes below 109 at November 30th, you're going to be able to buy the shares at 109, and you're going to be able to reduce that cost basis by an additional $148. So this is really where a lot of people, I think this is one of the more underutilized strategies, because many of you buy stocks and many of you place limit orders to buy that stock, but you may not have considered selling a put as an alternative to doing that. And you can do this for any stock that you type in. So if you click on American Airlines, here instead of buying it for $36.97, you can sell a November 30th 35.5 put. This gives you a $73 to basically put in an order to buy at 35.5. So if on November 30th the stock is trading below 35.5, you'll pay $35.50 for the stock, which is a little lower than where you are right now, but you're also going to, at the same time, lower your cost basis by almost 2% because you're selecting $73. And keep in mind, when you're trading at Firstrade, you keep all $73. You don't lose any of that to commissions. So every single dollar that you collect on this premium, you get to keep in your account. And then once you're ready to place that trade, you hit the trade button. You can hit the preview order button, and that will enter the order for you so that you don't have to enter anything manually. Lastly, what I want to do is I want to jump over to the trading tab, and I want to show you some ideas on credit spreads. So this is one of the strategies that, like I said, is very forgiving. It allows you to take a directional view on an underlying stock very quickly. So let me pull up some examples here. Let's look at United Healthcare Group. I'm pulling up this stock because this is a stock that's been trading within a fairly tight range here between about 257 or so and 272, and it's trading near the bottom of that range. Maybe you're mildly bullish on this. You don't know that it's going to go really high, but you're pretty sure that it's going to not go any lower and it might move a little higher. So this is really where you can take that directional view and turn it into a credit spread. You can modify any of these three strategies, and you can use a bullish, short put vertical, which is the credit spread. Like I said, I don't have enough time to really go into each one of these trades, but I want to show you guys how to set up one of these trades. We do have a separate webinar just on this one topic if you want to learn more about it. But most importantly, what it allows you to do is see how this strategy performs given your outlook on United Healthcare. And I think one of the cool things is that if United Healthcare stays exactly where it is at 274, or 275 rather, around that, this is the only strategy that allows you to profit from the stock basically staying where it is. So if the stock stays exactly where it is for the next month, you can actually collect $337 profit per contract that you sold this on. Versus if you bought a call option or a call spread, you actually end up losing money on each one of these, because if the stock stays where it is, you obviously don't make any money regardless of whether you buy the stock, buy the call, or buy the call spread. You actually lose money on two of those strategies. So selling a credit spread is really a strategy that allows you to take a directional view. So even if the stock moves a little higher, you're going to collect that premium. The only time that a credit spread really loses out is if you call the direction correct and it actually moves significantly in that direction that you expect it to. So if this stock moves up to 270, or let's say 280, as you can see, actually if the stock moves up to 280, you're still going to make the most amount of money from the credit spread. If the stock moves down to 290 or 210, that's when you're going to be able to get a significant return on the debit spread versus the credit spread. So that's just a really, really quick overview of these three strategies. Like I said, I don't really have quite enough time to get into this. So this stock is at 274. So this is actually significantly higher than where it is. Let's take a look at another stock. Here's another pharmaceutical. This stock took a beating over the last few weeks, is starting to recover. Maybe you think the stock's going to start moving higher. This allows you to modify this, turn it into a credit spread, and look at a few different examples of how to turn this into a credit spread. And you can use this tool to quickly change the expiration dates and strike prices, and use our P&L simulator to be able to simulate all different types of scenarios and see exactly how they will perform. So with that, I just want to thank everyone for taking the time out this afternoon and viewing this webinar. At this point, I'm showing you guys these three strategies. Like I said, this isn't in-depth one on all three. This is more of an overview of the different strategies that you can generate income with. And then what I want to do is I want to open this up for Q&A for those of you that have any questions on any of these three strategies. So I have a question here. Can you do credit spreads in a retirement account? That depends. If you're in an IRA account, you should be able to. So it depends on, you may have to ask Firstrade as to what you have authority to trade. Options Play offers condors. Can Options Play also set up iron condor credit spreads? When it comes to iron condors, an iron condor is basically two credit spreads put together. It's a call credit spread and a put credit spread. You generally don't want to trade iron condors because a put credit spread is bullish and a call credit spread is bearish. So unless you are completely 100% neutral, which that never is the case, because you're either a little bit bullish or a little bit bearish, you want to leg into an iron condor. You generally don't want to trade an iron condor as a whole. There's a question here, how do you get to Options Play again? So Options Play, you can click on the Options Trading tab, and you'll see a button here that says Options Wizard on the right-hand side. That's where you get it. Time decay is good for both if you're a seller of options. So time decay is only good if you're a seller, not if you're a buyer. So time decay is good for both put and call options, not just, as long as you're selling an option, time decay is working in your favor. Short puts really only works if someone exercises the put. So yes, but someone will exercise the put as long as the put is in the money. So if the stock is below that strike price on expiration, you should get assigned on that trade. What happens when you get assigned? Not much. You just have to either deliver the shares or buy the shares depending on whether it's a call or a put, and that's automatic in your account. Do short puts require a margin account? Yes, they do. On the short put, you're buying it at a lower price compared to the current price on a short put. How do you save on tax on calls? You're not saving on tax. It's just that if you have a low cost basis stock that gets called away on a cover call that you got assigned on, what I'm saying is that you don't have to deliver that low cost basis stock. You can buy more stock on Monday morning and deliver that. The IRS has no rules as to which tax lot you have to deliver. So if you have the cash to buy more, stock and deliver those, you can do that, and that will save you on a huge capital gains bill. If there are no more questions, I just want to thank everyone for taking the time out this afternoon. I really appreciate you guys taking the time out. This is a really fun webinar for me because we get to really talk a lot about, some of the various different option strategies that you can trade. And please take a look at some of the previously recorded webinars because we do get a lot more in-depth into cover calls, into credit spreads for those of you that want to trade those other strategies. So thank you very much. I really appreciate everyone taking the time out. And I hope to see you guys in 2 weeks when we do our next webinar. I hope everyone has a great afternoon.